Silver just dropped $7 in a single session. Futures traders are liquidating positions like the metal suddenly became radioactive. Financial media is calling it a correction, a healthy pullback, the end of the silver rally. And if you believe that story, you're about to miss the most violent price discovery event in precious metals history. Because what's happening right now isn't a correction, it's forced mechanical selling colliding with physical scarcity. It's passive index funds dumping 13% of COMEX open interest, while China just locked up 70% of global supply. It's paper flows meeting reality. And when this 5-day rebalancing window closes on January 15th, the algorithm-driven sell-off stops, but the supply crisis doesn't. What happens next isn't a prediction, it's arithmetic. My name is Alex, and for the past 8 years, I've been obsessed with understanding market mechanics that don't make headlines until after they explode. I study the plumbing of financial systems, the technical structures most people never see until something breaks. And right now, silver's plumbing is about to rupture. If you're trying to understand what's really happening in precious metals beyond the noise, make sure to hit that subscribe button and give this video a thumbs up if it cuts through the confusion. Today I'm going to show you exactly why this sell-off is mechanical, not fundamental, and why the setup for what comes next is unlike anything we've seen in commodity markets. Here's what everyone thinks is happening. Silver rallied too far, too fast. It hit $83.97 on December 29th, a 145% gain for the year. That's unsustainable. Markets need to cool off. Profit taking is natural. The bulls got ahead of themselves, and now reality is setting in. That's the narrative. That's what makes sense to people who think markets are rational and prices reflect fundamentals. Except that's not how it actually works. Because the $7 drop from 84 to 77 didn't happen because fundamentals changed. It happened because Bloomberg Commodity Index rebalancing rules force passive funds to mechanically adjust their silver weighting when prices move beyond certain thresholds. Silver's weighting in the index jumped to over 9%. The rules say it can't exceed a certain cap. So between January 9th and January 15th, index funds must dump futures contracts worth $5 to $7 billion. Not because they want to, not because silver's outlook changed, because the algorithm says so. Daniel Gali at TD Securities called it. He warned this could result in dramatic repricing lower. He's right about the repricing. But here's what nobody's telling you about that warning. These are paper flows. Price-insensitive mechanical selling that has nothing to do with supply, demand, or value. It's passive money following rules. And while that selling is happening, something else is happening that changes everything. On January 1st, China implemented new export licensing requirements for silver. Only state-approved firms producing 80 tons or more annually can now ship refined silver overseas. Elon Musk responded within hours. He said this is not good. Silver is needed in many industrial processes. He's absolutely right. And here's why that matters more than most people realize. China controls 60 to 70% of global refined silver supply. Not 40%, not half, up to 70%. And that valve just tightened to a trickle controlled entirely by Beijing. So you have $5 to $7 billion in forced futures selling, creating downward price pressure on paper markets. And simultaneously, you have the world's dominant silver supplier restricting physical exports through bureaucratic licensing that favors state entities over private markets. The paper price is dropping while the physical metal is getting harder to access. Let me say that again because it's the entire story. Paper selling is pushing price down. Physical scarcity is increasing. Those two forces don't resolve peacefully. They resolve explosively. Now, I know what you're thinking. Markets have survived rebalancing before. China has made trade adjustments before. This sounds like temporary volatility, not a structural crisis. And that's exactly what makes this moment so dangerous to miss. Because what I'm about to show you next is the thing that took me years of data analysis to fully understand. The current setup isn't just about rebalancing or Chinese policy. It's about a structural supply deficit that's been draining global inventories for 5 consecutive years, while industrial demand accelerates into technologies that cannot substitute away from silver. And that deficit just collided with mechanical selling and geopolitical supply restrictions at the exact same moment. Let's start with the deficit. Since 2021, global silver markets have experienced supply shortfalls totaling 820 million ounces. That's not a single year shortage. That's cumulative across 5 years. To put that in perspective, global mine production runs around 813 million ounces annually. The deficit over the past 5 years equals an entire year of worldwide mining production. That silver came from somewhere. It came from above ground inventories. It came from stockpiles. It came from reserves that are now gone. The 2025 deficit hit 95 million ounces despite record prices. In a functioning market, when prices rise 145% in a year, supply should flood in. Producers should ramp up. Speculators should sell. The deficit should shrink or flip to surplus. It didn't. It widened. The 2024 deficit was 148.9 million ounces. 2023 was comparable. 2022 was comparable. Year after year, global silver consumption exceeds production by margins that would bankrupt any other commodity market. Here's why supply can't respond. 65% of silver production is a byproduct of mining other metals: copper, lead, zinc, gold. Miners aren't digging specifically for silver. They're extracting other metals, and silver comes along as a secondary output. When silver prices spike, those miners can't just produce more silver. They're not running silver-focused operations. They're bound by the economics of the primary metal. Global mine production has been essentially flat at 813 million ounces for years because you can't just open a silver mine in response to price signals. Mine development takes 6 to 8 years. Permitting, exploration, construction, ramp-up. By the time a new mine produces its first ounce, the price environment that justified the investment has usually changed twice. So supply is structurally inelastic. Meanwhile, industrial fabrication exceeded 680 million ounces in 2024. Forecasts show it crossing 700 million ounces by 2026. Industrial demand isn't speculative. It's manufacturers building solar panels, automakers producing electric vehicles, electronics companies making semiconductors. These aren't traders flipping contracts. These are factories that need physical metal to operate. And here's where it gets critical. Photovoltaic demand alone consumes over 200 million ounces of silver annually. The International Energy Agency projects that will reach 250 million ounces by 2030 as global solar capacity grows at 17% compound annual growth rate. Each solar panel requires 80 to 100 milligrams of silver paste to create the conductive pathways that convert sunlight to electricity. There is no substitute that matches silver's electrical and thermal conductivity at scale. Researchers have tried copper, aluminum, graphene. None of them work as efficiently in mass production. Solar manufacturers are locked into silver. Electric vehicles use up to 50 grams of silver per vehicle. That's double what traditional internal combustion cars require. EV charging infrastructure, battery management systems, autonomous driving sensors. All of it relies on silver's unique properties. As EV adoption accelerates, so does silver consumption. And that demand is inelastic. Automakers can't suddenly switch to a different metal without redesigning entire electrical architectures. By 2030, research from ScienceDirect projects that supply will meet only 62 to 70% of total silver demand. Total annual requirements could reach 48,000 to 54,000 tons. That's assuming mine production increases, which it hasn't been doing. That's assuming recycling scales up, which faces its own technical and economic limits. And that's assuming no additional demand shocks from new technologies or industrial applications. If you've made it this far, you're already ahead of 90% of people watching financial media explain this as a simple correction. But don't stop now, because the next part is where the mechanics of what's coming into focus get truly wild. So here's where we are. 820 million ounces of cumulative deficit over 5 years. Supply that cannot respond to price because 65% is byproduct mining, with 6 to 8 year development timelines. Industrial demand growing at double-digit rates in sectors that cannot substitute. And now, China implementing export restrictions that lock up 70% of global refined supply behind state-approved licensing. Let me walk you through what happens when the rebalancing window closes. Right now, passive index funds are mechanically selling futures contracts to bring their silver weighting down from over 9% to under 4%. That's $5 to $7 billion in selling pressure spread across 5 trading days. January 9th through January 15th. Every day during that window, algorithms execute programmed trades, sell silver futures, adjust portfolio weights, rebalance the index. The selling isn't driven by outlook or fundamentals. It's driven by compliance with index methodology rules. But here's what happens on January 16th. The rebalancing mandate ends. The algorithm-driven selling stops. The mechanical downward pressure evaporates, and suddenly the market has to price silver based on actual supply and demand instead of passive fund rebalancing flows. What does that supply and demand picture look like? China's export restrictions are still in place. The 820 million ounce deficit is still real. Industrial buyers who deferred purchases during the volatility still need metal. Solar manufacturers can't just stop building panels because silver got expensive. EV makers can't halt production lines. Commercial shorts who covered positions during the sell-off will need to rebuild hedges. These are mining companies, industrial users, financial institutions that use futures markets to manage price risk. When they sold their hedges during the drop, they locked in favorable prices. But they still have ongoing production, ongoing consumption, ongoing exposure. They'll need to re-enter. Momentum algorithms that sold the breakdown will flip long when price stabilizes and shows reversal signals. High-frequency trading systems don't care about fundamentals. They follow price action. When selling exhaustion shows up on their models, they switch sides. All of this buying pressure hits a physical market where the cracks are already showing. In October, London nearly ran out of silver. Lease rates, which measure the cost of borrowing physical metal, spiked to record levels. Lease rates spike when available inventory gets tight and people who need metal right now are willing to pay premiums to access it. That happened before China's export restrictions. That happened before rebalancing forced selling. The physical shortage signals were already flashing red. Now take that tight physical market and remove 70% of global refined supply from free market access. China's new licensing system means only state-approved entities can export. Private refiners, smaller producers, market-responsive suppliers are cut out. The metal that would normally flow to whoever pays the highest price now flows according to Beijing's priorities. Maybe that's domestic industrial use. Maybe that's strategic stockpiling. Maybe that's geopolitical leverage. But it's not flowing freely to global spot markets where prices are discovered. Goldman Sachs and UBS both called this sell-off a healthy correction, not a trend change. Let me translate that for you. They're telling institutional clients that the fundamental bull case for silver remains intact. The price drop is technical, not fundamental. It's driven by mechanics, not by a shift in supply-demand balance. And when technical selling driven by index rebalancing collides with fundamentally tight physical markets, the resolution isn't gradual. It's not a smooth adjustment. It gaps. Because supply can't increase fast enough and demand can't decrease fast enough. Here's the trap that paper markets are walking into. COMEX currently has over 107,000 open contracts. Each contract represents 5,000 ounces. That's 538 million ounces of silver that futures holders theoretically have claims on. But here's the thing. COMEX doesn't hold 538 million ounces in registered inventory available for delivery. Registered silver, the metal actually available to fulfill delivery requests, runs far lower. Most futures contracts settle financially, not physically. Traders close positions before expiration and take cash profits or losses instead of taking delivery. But what happens when industrial users who actually need metal start demanding physical delivery because spot markets can't source enough from China? What happens when the gap between paper claims and available physical metal becomes undeniable? Lease rates spike, delivery delays lengthen, premiums over spot explode, and eventually, price gaps violently higher because the paper market realizes it can't deliver against its obligations without draining every available ounce. Let me tie all of this together, because when you see how these pieces connect, the setup becomes crystal clear. You have structural deficits totaling 820 million ounces over 5 years. You have supply that can't respond because of byproduct mining economics and 6 to 8 year development timelines. You have industrial demand growing at 17% annually in solar alone, plus accelerating EV adoption, plus electronics, plus everything else. You have China controlling 70% of refined supply and locking it behind state licensing. You have 813 million ounces of annual mine production that's been flat for years. You have lease rates that already spiked to records before any of this rebalancing chaos started. And you have passive index funds mechanically dumping $5 to $7 billion in futures over 5 days, creating a temporary price drop that has nothing to do with fundamentals. The rebalancing ends January 15th. What happens after isn't a mystery. Industrial buyers re-enter. Commercial hedgers rebuild positions. Momentum algorithms flip long. And all of that demand slams into a physical market where China just weaponized the supply chain and 820 million ounces of inventory are already gone. Now let me tie all of this together with what the smart money is actually saying. Because when you see the price targets institutions are modeling, the psychology of what's happening right now shifts completely. Bank of America published research projecting silver could trade anywhere between $135 and $309 per ounce. That's not a typo. $309. Their analysis is based on supply constraints, industrial demand acceleration, and monetary debasement dynamics. BNP Paribas forecasts $100 by late 2026. Kiko's most recent investor survey showed 57% of retail participants expect silver above $100 this year. Not in 5 years. This year. The gold to silver ratio collapsed from 107 in April to 56 at year-end. When that ratio drops, it signals massive institutional rotation into silver relative to gold. For context, the historical average ratio sits around 65. When it drops below 60, it usually means silver is outperforming dramatically. When it hits 56, it means capital is flooding into silver faster than gold, and institutions are positioning for supply shortages. Robert Kiyosaki, who called $70 before year-end and nailed it, now forecasts $200. He's been vocal about silver as the most undervalued asset in precious metals for years. His thesis is simple. Silver is both a monetary metal and an industrial commodity. It benefits from currency debasement like gold, but it also benefits from technology adoption that gold doesn't participate in. Solar, EVs, semiconductors, 5G infrastructure, all of it consumes silver. None of it consumes gold. Here's what makes this moment so binary. The $7 drop from 84 to 77 is mechanical. It's index funds executing algorithm-driven rebalancing to comply with methodology rules. That selling is price insensitive. It doesn't matter if silver is cheap or expensive. The algorithm sells because the weighting exceeded the cap. But the 820 million ounce hole in global inventories is physical. China's 70% supply lock is physical. The inelastic industrial demand from solar and EV production is physical. The 107,000 COMEX contracts representing 538 million ounces must eventually settle in a market where real metal is increasingly scarce. Paper markets can suppress price temporarily through mechanical selling. They've done it before, but they can't suppress price indefinitely when physical shortage becomes undeniable. At some point, industrial users who need actual metal will pay whatever it takes. At some point, lease rates spike so high that holding paper becomes more expensive than buying physical and taking delivery. At some point, the gap between registered inventory and open interest becomes so extreme that the market reprices violently. That repricing doesn't happen gradually. It doesn't follow a smooth trendline. It gaps overnight when physical tightness forces a reset. We saw this in nickel in 2022 when London Metal Exchange had to halt trading because short squeeze mechanics broke the market. We saw it in palladium when automotive demand collided with Russian supply restrictions. We're seeing the exact same setup in silver right now, except the scale is larger and the demand sectors are bigger. The rebalancing window closes January 15th, 5 trading days of forced mechanical selling. And then what? The algorithm stops. The passive flows disappear, and the market has to price silver based on reality. China's export restrictions stay in place. The supply deficit stays in place. Industrial demand stays in place. Solar manufacturers still need 200 million ounces annually. EV makers still need 50 grams per vehicle. Electronics companies still need silver for semiconductors and 5G. Here's the psychological trap most people fall into. They see price drop $7 and assume something fundamental changed. The rally is over. The momentum broke. Time to take profits or cut losses. But nothing fundamental changed. Supply didn't increase. Demand didn't decrease. China didn't reverse export restrictions. The deficit didn't disappear. The only thing that changed is passive index funds executing program selling to comply with rebalancing rules. When retail investors panic sell during mechanically driven drops, they're selling to institutional buyers who understand the difference between technical selling and fundamental deterioration. They're handing positions to smart money at discounted prices, and when the mechanical selling ends and fundamentals reassert, those institutional buyers will be sitting on positions acquired during artificial price suppression. This is how markets transfer wealth. Not gradually, not fairly, Not fairly. Through volatility that shakes out weak hands while strong hands accumulate. The 5-day rebalancing window is a gift to anyone who understands what's actually happening. It's forced selling, creating temporary price dislocation in a market where supply is locked up, inventories are drained, and industrial demand is inelastic. Your future self, the one who looks back on this moment a year from now when silver has repriced to reflect physical scarcity, is counting on you to see through the noise. The headlines will say correction, the charts will show a drop, but the fundamentals say something completely different. 820 million ounces of deficit. China controlling 70% of supply. Solar consuming 200 million ounces annually with 17% growth. 6 to 8 year mine development timelines that can't respond to price signals. Lease rates at records. London nearly running out of metal. And passive funds mechanically dumping $5 to $7 billion in futures over 5 days before stepping aside. What financial topic is affecting your decisions right now that you can't find a straight answer on? Market mechanics, commodity dynamics, monetary policy, whatever keeps you up at 3 in the morning trying to understand what's really happening beneath the headlines. Tell me in the comments. That's what this channel is for. Cutting through the narratives to show you the plumbing that actually moves markets. The rebalancing ends. January 15th, the mechanical selling stops, but the 820 million ounce deficit doesn't stop. China's export lock doesn't stop. Solar demand doesn't stop. And the 107,000 COMEX contracts representing 538 million ounces of silver will need to settle against a market where physical metal is vanishing. Price doesn't stay suppressed when paper selling meets physical shortage. It gaps, not because of speculation, because of arithmetic. The math is undeniable. The timing is binary. And what happens when this window closes isn't a prediction. It's the inevitable outcome when forced selling collides with structural scarcity in a market that can't increase supply for 6 to 8 years. 5 days left. Then the algorithm stops, and reality reprices everything.